Welcome to Study Loop.
So Yummy Candy Company is considering purchasing a second chocolate dipping machine in order to expand their business. And the information Yummy has accumulated regarding the machine is on the table. And they estimate that they'll be able to produce more candy using the second machine and increase their annual contribution margin. And they also estimate that there will be a small disposal value of the machine, but the cost of removal will offset the value, and ignore income tax issues on your answers. So assume all cash flows occur at the year end except for initial investment. Um Initial investment account. Calculate the following for the machine. So the first one, what to calculate the net profit value. So the formula for net profit value is the present value of cash flows minus the present value of cash inflows minus present value of cash outflows. So for this, from the table, the NPV will be 110,400 minus 80,000, and the NPV will be 30,400. Now, further, the present value of the cash inflows and outflows will be calculated as the following. So, the present value of the cash inflows would be P open brackets 1 minus 1 plus R raised to power minus n divided by R, and R is the periodic payment, P is the periodic payment, R is the rate, N is number of period. So here we know that P is 15,000, R is 6%, and N is 10 years. So then the PV the PV of the inflow will be 15,000 1 minus 1 plus 0.06 raised to power 10 divided by 0.06, and then this will be 15,000 multiplied by 7,360, and this will be 110,400. So this is for the inflow. Now for the outflow, it will be the cost of the new machine, and that's equals to $80,000. So moving on to the next question, the payback period. So the payback period is like the computation of the period of recovery of initial investment from the cash inflows. So the formula is initial investment divided by the annual future cash flow inflows. And then this is equals to 80,000 divided by 15,000, and this equals to 5.33 years. So the payback period for the initial investment is 5.33 years. Now moving on to the next question. The discounted payback period. Now for this, we'll have to write the number of years, then the cash savings. Oh, well, I'm going to write it as a table. So we'll have the years from 1 to 10. Then we have cash savings. So let me number the years from 1 to 10. Actually, from 0 to 10. And then the cash savings, we have 15,000 for everything. And then the next one is the present value of $1 discounted at 6%. And then we have the discounted cash savings, and this is 2 multiplied by 3. And then we have the cumulative discounted cash savings, and then we have the net initial investment uncovered at the end of the year. So for the present value of $1 discounted at 6%, this will be 0.943, this will be 0.89, this will be 0.84, 0.792, 0.747, 0.705, 0.665, 0.627, 0.592, and 0.558. Now for discounted cash savings, it would be the cash savings times the present value. So this would be, so you multiply 2 times 3. And then the discounted cash savings is basically adding 1 plus 2, 2 plus 3, 3 plus 4, just like that. 110,385. Now for the next initial investment at the end of the year, this will be 65,855. This is 52,505. This is 39,905. This is 28,025. This is 16,820. This is 6,245. And the rest is zeros. So we can tell that it's in the seventh year that the initial investment, if you scroll down, is fully recovered. So the initial investment is recovered around the seventh year, and the discounted payback period correlation will be calculated as so initial investment is recovered in year 7, and then the discounted payback period will be equals to 6 years, and that's 6,245 divided by 9,975, and this is 6. So this is 6 years plus, I'm sorry, plus that. So this equals to 6 plus 0.63, and discounted payback period is 6.63 years. Now the next question, the initial rate of return. So this is the method to compute the internal rate where the NPV is 0. So the initial rate of return using the interpolation method would be so this is the formula, and then this will be 10 plus 15 minus 10 multiplied by 12,175 divided by 12,175 minus 4,715. So this is equals to 10 plus 3.60 or 13.60%, and that's the initial rate of return. So moving on, the NPV is positive at 6% and NPV is now calculated at 10%. So reference to the NPV, we're going to calculate the present value of inflow and present value of and net present value. So present value of inflow is 15,000 open brackets 1 minus 1 plus 0.1 raised to power 10 close brackets on over 0.1, and this is 15,000 multiplied by 6,145. I'm sorry, 6.145, and this is equals to 92,175. Now the present value of outflow is the cost of new machine, and this is equal to 80,000. Now the net present value would be the difference. So 92,175 minus 80,000, and this is 12,175. So that's the difference. Now we're going to calculate the NPV2 at 15%. So the present value of inflow would be 15,000 open brackets 1 minus 1 plus 0.15 raised to power 10 over 0.15. So this equals to 15,000 multiplied by 5.019, and this is 75,285. Now the present value of outflow is equal to the cost of new machine, and this is equal to 80,000. Now the NPV will be the difference, 75,285 minus 80,000, and we can see it's a negative 4,715. So it is negative. So moving on to the next question. The accrual accounting rate of return based on the net initial investment. So we need to find the accrual rate of return. And this is the computation of the rate of return of net operating income after the taxes over the initial investment. So first we need to calculate the depreciation under the straight line method, and the depreciation is 80,000 divided by 10 years, and this is $8,000. So now the AARR would be the increased annual contribution plus annual depreciation divided by initial investment multiplied by 100. So this is 15,000 minus 15,000 minus 8,000 divided by 80,000 multiplied by 100, and it's going to give you the accurate accounting rate of return of 8.75% per year. Now, the second part of the question: what other factors should Yomi Kandi consider in deciding whether to purchase the new machine? So, I would say they should consider if the demand is enough to meet the supply. They should also consider availability of funds to purchase the machine. They should also consider the maintenance cost to run the machine on a regular basis. And lastly, they should consider whether the technological obsolescence is expected in near future. So these are the factors they should consider before deciding to purchase a new machine.